What up, guys? It's August 6th, and I want to spend some time to go over NXP Semiconductor and their second quarter earnings report and earnings numbers, and why we like the stock and what it's doing and what we believe for the future. Okay, I kind of was on vacation for a week. I'm back. I'm kind of catching up on these videos. I'm going to give you guys a breakdown of the overall market later on tomorrow. And then I'm going to break down a couple more stocks that I've already reported in my portfolio, like Ford, AMD, Rocket. Also, we had, what else do we have? DraftKings. We're going to go over a bunch of those in other videos, okay? But before we get started, hit that like button, hit subscribe. Hopefully, we learned something from these videos and we have some fun in the meantime. Let's get going. So I'm going to refresh you guys on NXP Semiconductors. I've already done a video about this in the past, but essentially 4 major end markets, 4 major business segments for NXP Semiconductors. We're talking automotive, industrial, and IoT. That's Internet of Things, mobile, and communication infrastructure, also known as telco or telecommunications, telecom. You can hear that over on CNBC or Fox Business. When you hear about telco or telecom, that's what they're talking about, okay? Communication infrastructure. If we look a little bit further down here on their investor presentation, this is from their investor relations site, we'll see here how big their business segments are compared to the overall business. So this is the reason we own the stock right over here. 50% exposure to automotive semiconductor chips, and then 22% to industrial and Internet of Things. Okay, so what we have to understand too about these two business segments is this is what drives NXP Semiconductor. This is more of a steady Terry type business segments for mobile and communication infrastructure. Here we're talking a lot of Android and Samsung. Here we're looking at a lot of cell towers and things like that, or cell tower components, things of that sort. And you can see here further down on their following slide for their investor presentation that, yeah, automotive and industrial and IoT are the ones that are getting that 9 to 14% CAGR. That's compounded annual growth rate. That's what it stands for. And we're getting the biggest boost from these two segments of the business. Like I said, these are more of the steady Terrys. As you can see, these growth rate here for communications and mobile, they're not as aggressive as the automotive and industrial. Again, we own NXP because of their automotive exposure. We think these CAGRs are a little bit low, right? And this is what they've been doing. But in the future, these are looking more like 20-25% when these automakers get ramping up, okay? So this is the reason we own the stock right here in a nutshell, okay? Now, moving on. If you also want to see a little bit more about NXP, I would recommend that you visit their website and look at their technology showroom. This is a digital showroom for technology, and I've kind of talked about this before, but when you look at something like automotive, you can see all kinds of components that they're telling you about that they're making, okay? We've got vehicle architecture, service-oriented gateway, infotainment, right? This radar, UWB radar evolution is really, really cutting-edge stuff in which you can actually you can actually have data on your passengers and their whether they're awake, whether they're asleep, what their heart rate is, whether they're breathing or not. Really useful stuff, especially for kids, okay? We also have electrification, high voltage battery management system. This is something that we know for sure that Volkswagen is using on their electric vehicles. ADAS, that's your self-driving technology, and also security so your car doesn't get hacked, okay? There's also some interesting stuff here going on the industrial side when it comes to healthcare. Some really, really interesting stuff with the NXP Smart Patient Experience. I was looking a lot about this because this is a new thing that NXP is doing, in which you can use your smartwatch, you can use several devices to monitor your health, or for your doctors or your medical staff to monitor your health from the comfort of your home. So they know at all times what your heart rate is, what your oxygen level is, all kinds of data that shoots back through a secure cloud to your doctor, to your medical facility, to allow them to know how you're doing. I think this is pretty cutting edge stuff, and very excited for this side of the business to kind of take off a little bit more. Okay, so enough of that. You guys can look through the showroom and actually see everything when it comes to NXP. There's a lot of cutting edge stuff. I'll mention one more thing. There's some stuff here about about like plants generating energy for chips, for low energy chips, pretty cutting edge stuff. That doesn't excite me so much as the cars and the medical stuff. But at the end of the day, take a look. There's a lot of stuff here to unpack. I've probably spent hours on this showroom looking at absolutely everything, make sure I understand the business from top to bottom. Okay, now moving on, we're gonna go into their earnings. Okay, so before we kind of look at all these numbers, I want to look at this right here, which is their market cap and their metrics. This is a cheap stock, and according to my favorite metric to determine how cheap or expensive a stock is, which is the forward PE, it's trading at 13 times a forward PE metric. So this is 13 times next 12 months expected earnings. And like I said, the earnings expectations are low for NXP Semiconductor. The market is expecting a 20% growth rate, or the majority of the market is. I mean, several different analysts could have something different, but I think this is the consensus, about a 20% growth rate. If we have car manufacturers really ramp up in the second half of the year, which is likely, depending on how interest rates go up or down, I think that this is going to be low, okay? In the meantime, if the stock falls under its share price or under our cost basis, we'll keep adding happily and making this position larger and larger and reducing our cost structure in the meantime, okay? So again, forward P of 13 I think is dirt cheap. Definitely at a discount against the market. So very nice stock to own. It's a tech stock that is kind of valued like a value stock, in my opinion, okay? So we're talking about EPS first, earnings per share. We have a beat, more profitable than expected by 10 cents, and also a revenue beat with positive cash flow of $551 million. Positive cash flow is amazing because it enables this business to take this free money that they're making as pure profit, reinvest it into the business, or buy back stock or increase the dividend, which they've done. Okay, they've also increased guidance a little bit from 3.35 to $3.5 billion for next quarter. The consensus was 3.33, so that's an increase in guidance, which is good, which is what the market is looking for these days. Guidance is very important. I talked about it in a prior video, how guidance was everything for Q2 earnings season. Okay, so again, triple beat, guys. Triple B's on the stock. We love it. And the action shows us that it's definitely something that's justified here. Okay, now I'm talking about the share price, $181 a share. In the last month after they reported earnings, the stock has seen a nice recovery, but so has the market, okay? But it's still trading at 13 times forward earnings. So any price that you see under 180, 175, I think is a steal, because this is a clear $250 stock in my book. So if I'm buying it under 175, I think you're golden. If you're buying it under 170, it's like stealing money at the end of the day, in my opinion, okay? And I want to show you here some boost or target boost or price boost by Morgan Stanley, Needham, and Cowen, okay? They're giving these target boosts on the stock. The more aggressive of the two being Cowen here. I think also back then, what did we have here? We had some lowering by Mizuho, Deutsche Bank, and Goldman. Goldman are a bunch of jerks at the end of the day. Who cares what they say? But we're looking at a lot of upside. If you listen to Needham, that's a lot of upside here. 220 to 225. That looks like it's the most aggressive price target increase there. But as the industry gets better and most electric cars start getting out there and they increase their EPS and their revenues, I think that we're going to see more target boost, more towards the 300 side in the next couple of years. So we're totally okay waiting for those price target boosts. Okay, now let's talk about the conference call. So remember, the conference call you listen to whenever a company reports their earnings. You have to listen to what management says. I've been kind of favoring reading the transcript as opposed to listening, because listening, you can kind of miss a lot. You kind of have to listen over and over again. I like to read these transcripts now. They get posted on Seeking Alpha. I definitely recommend that if you're not a member of Seeking Alpha, you become a member of Seeking Alpha. You can have access to all these things that they provide, beautiful metrics and everything on each stock. Okay, so let's start about number one here. So automotive, industrial, and IoT business segments are above guidance. Okay, so they did better than they expected themselves, while telco and mobile were in line with guidance. Of course, right, just like we talked, the telco and the mobile are the steady Terrys. Automotive, industrial is the growth side of the business, okay? And we see here automotive at a 36% annual growth rate, and IoT and industrial at 25%. Amazing growth. And telco and mobile leading the rear here. Okay, so nothing wrong with that. When we're talking about mobile, I think here they're saying the low-end Android market is not doing well. And they're not exposed to the low end, they're exposed to the high end, and the high end is still doing well, which I like, because we know from all the banks reporting their numbers at the first week of earnings season that high-end spenders or rich folks were doing just fine. The people that are kind of more the middle class and lower middle class are not doing well because of inflation. So NXP is exposed to rich folks more than anything. And that's what we like, okay? So doing very well there, okay? They're saying we have a high level of confidence in the intermediate term outlook. That's 3 to 6 months when we're talking intermediate term. Anything long term, it's 6 months or more. Short term, we're talking about a month or so when we're talking about short term. So they're saying they're very confident, which means, hey, I am too as a shareholder, okay? They're saying we don't see any substantial weakening with the auto and industrial IoT customer base. Of course, very strong demand there. They're saying, hey, the level of NCNR, no cancel, no reservation orders, into 2023 is greater than their ability to service that demand. They're talking about here 80% of their demand is currently being met. So that's 20% that is still not out there that they could still boost into and make more money on and give us more money as shareholders, okay? Supply chain is still stubbornly dysfunctional. We know that. Everybody's reporting that same thing. And the bad thing about the conference call here, record level of inventory, about 1.5 billion worth of inventory. We're not talking about chips that are actually done. We're talking about raw materials, and that is a record high for 2022. So this could be a little bit of a hedge because, like I said, if these car manufacturers really start to ramp up, this excess inventory is going to come in quite handy for NXP. If that doesn't happen, then we're going down. But that's okay because we're long-term investors and we'll just take advantage of cheaper shares at that moment, okay? Companies paranoid about the macroeconomic environment and will watch these inventory levels to remain lean across all end markets, okay? So semiconductors are kind of like a commodity. The more there are out there in the economy, the less they're worth. The less there are, the more they're worth. So they have to kind of make sure they stay disciplined to keep that cost structure intact, all right? Let's move on. Now let's go over my opinion on the stock, okay? And we're talking about the first thing we like about the stock is this is a secular growth trend, and we're talking about cyclical and secular. That's the two categories. So cyclical stocks are the stocks that need a strong economy to do well. We're talking like retailers, like an Amazon, like a Facebook. They need a strong economic outlook in order to do well. Secular stocks are quite the opposite of that. They're stocks that will grow no matter the state of the economy because the demand for their products is high regardless of economic activity, okay? So there's this secular trend occurring in the automotive sector with electric vehicles. That's no mystery to anybody, okay? And that translates into a huge TAM opportunity. I still think that with NXP, we're still very early because NXP is not a Tesla type producer. They're producing semiconductor chips for Ford, for Honda, for Toyota, for Volkswagen, but for the electric makers, we're looking right now at Volkswagen and Ford, which are ramping up production of their electric vehicles. So we still think we're very early in this trend of growth in electric vehicles when it comes to these semiconductor chips, okay? And this demand will remain high for the next 5 to 10 years. That's no doubt. I don't think it's a doubt in anybody's mind that the demand will stay high, okay? And we think that management has executed very well, and they're going to remain disciplined with their inventory levels like we talked about, okay? Stock is cheap, guys. When I say enticing, I mean cheap as well. Ford P of 13 with a growth rate of 15 to 20% and a mid-cap stock. That's pretty impressive. They've done very well. I think the stock, you could buy it at any level that it's been in the last month or so. Modern portfolios. We're talking modern portfolios. You need exposure to semiconductor chips in modern portfolios. Otherwise, you're running a 2005 style portfolio if you do not have these semiconductors in your portfolio. With our strategy, we have 3 different stocks that we're using for semiconductor exposure. We're using AMD for data center and high performance computing. We're using Marvell technology for 5G data center and business exposure, business 5G. And we also have NXP for automotive and industrial. So I think we're pretty well covered across all sectors of the semiconductor kind of field, because if you look around everywhere, your work, your house, everywhere, there's a computer chip in everything now. So the exposure to these chip stocks is absolutely imperative, if you ask me. Okay, I'm happily buying this stock under 180, happily any day of the week, and I'm continuing to reduce my cost basis and building a larger and larger position. So when these trends kick off, we just see the benefits for ages, and we're collecting dividends while that's happening. They just increased their dividend by, I think it was like 25%. So we're totally fine collecting dividends. In the meantime, we're also going to reap the benefits of share buyback programs, currently at $3 billion remaining for the stock, okay? Now, my last take on the stock I'll give you here is the balance sheet, which the balance sheet is not perfect. It is a debt-heavy balance sheet, okay? If we're looking at here, we're looking at total debt of about $11 billion and total cash about $3.5 billion. This is a debt-heavy balance sheet. So you have to realize that when you buy these companies that are debt-heavy, they must be profitable. These companies have to have free cash flow, which for NXP, we're looking at $500 million of free cash flow every quarter. So this is an okay balance sheet in my book when you have free cash flow to make up for a debt-heavy balance sheet. But NXP can actually choose to say, hey, let's kind of pause the $3 billion share buyback, because if you add that share buyback, $3 billion to this, now you have 6.5, right? Plus the free cash flow, you're looking at about $7 billion already. So I think the balance sheet is totally okay if the company remains profitable, and I think the profitability will continue to soar. Remember, we talked about EPS. They're more profitable than expected. I think they'll still continue to surpass those expectations for NXP, okay? So that's going to be my take on NXP Semiconductor and their second quarter 2022 earnings, okay? If you guys have any questions, please let me know. Be happy to help you. Please reach out to me here in the comments section, on Instagram at the Wall Street Rooster, or on Twitter. I'll drop the links below. Peace out.